Hi everyone. I hope you people are able to hear me. Can you people hear me? Hello? Can you people hear me? Okay, great then. So, as you all know, we left this question yesterday. I just assumed a constant dividend with a constant growth. And let's solve this question again. Uh, so we were supposed to calculate the cost of equity, and then we were supposed to calculate the value of equity using dividend valuation model. Now, uh, remember one thing, whenever we are calculating the value of any company or calculating value of anything, we always value something on the basis of its usefulness, uh, or on the basis of the benefits that we expect from that thing in the future. For example, if I'm going to buy a cell phone, I will always value that cell phone based on what benefits I can get from using it in the future. Similarly, if we are buying a company, we'll have to look at the benefits that we will be receiving from that company in the future. Now, the benefits are usually in the form of cash flows, or they are in the form of dividends, or they are in the form of earnings. So we might be valuing the company based on the earnings. We may be valuing the company based on dividends, or maybe valuing the company based on the net cash flows that it will generate in the future. So according to this question, it is asking us to value the company based on the dividends. If you look at the B part, calculate the current cost of equity of correct company, and using this value, calculate the value of the company using the dividend valuation model. So based on the dividends that we are expecting to receive from this company in the future, we have to value. So the value of the company will be actually the present value of the dividends that we are going to receive in the future. So all we need to do is to find out the present value of the future dividends, and that will be the value of the company. Now for that, we need a discount rate, and the discount rate should be the cost of equity. Now, since we are using the dividend valuation model for valuation purpose, we can't use the dividend valuation model for calculating the cost of equity. We can use dividend valuation model either for valuation or for cost of equity. We can't use one model in the same question for calculating two variables. So whenever the question asks us to calculate the value of the company using the dividend valuation model, remember the cost of equity will be calculated using the CAPM model. So first of all, let's use the CAPM model for calculating the cost of equity. And I think we did calculate the cost of equity in the last class, but let's repeat it again. So cost of equity will be equal to the risk-free rate of return, which is 4%, 0.04, plus equity beta. The current equity beta of the company is 1.6 into the risk premium, which is 5%. So the equity beta of this company, the cost of equity of this company is 12%. Now we have to use this cost of equity as our discount rate for calculating present value of the values of the dividends. Now, according to the question, in the very first year, that is in the next year, the company is not expecting to pay any dividend to its investors. So for the first year, there will be no dividends, therefore no present value. But in the second year, the dividend will be $500,000, and we need to calculate the present value of these $500 and then $1,000 present value, and then the present value of the dividend that we will be receiving thereafter. So present value of year 2 dividends. Present value of year 2 dividends will be is equal to 500 into discount factor, and we may either pick the discount factor from the table or we may apply the formula. So let's apply the formula. 1.12%, 1 plus 12% raised to the power minus 2, because this dividend will be paid in year 2. And let's change the format to, now as you know that these values are in thousands, so then we need to calculate the present value of year 3 dividends, again in thousands. Excuse me. So we'll just copy this formula, and after copying this formula, we'll just change the variables. Instead of 500 in the third year, the dividend will be 1,000. 1 plus not B3, it's still B2, and raised to the power minus 2. So this will be the present value of dividends for year 2. Now that if in case this company will stay only for 3 years, then the total value will be the sum of these two. But definitely the company will stay for a foreseeable future. It will continue for a foreseeable future. So we have to calculate the present value of the dividends after 3 years as well. So here we go. It says that the company is optimistic that earnings and dividends will increase after 3 years at a constant annual rate of 3% per year. Now after that, the dividends are supposed to grow at 3% per year, but this will be in perpetuity. So whenever the dividends will continue forever, we'll simply use the dividend growth model formula for calculating the price, that is the present value of the dividends. So we have to use the dividend growth model for the dividends to be received in perpetuity. So present value of dividends after third year, again it should be in thousands. This is for year 3. So we'll use the dividend growth model for calculating the present value or the price of this, the present value of the dividends. So the dividend growth model, the dividends, the latest dividend will be, the last dividend will be 1,000. So 1,000, okay, into growth. The growth is 3%, so we'll write 1.03. Then we will whole divide this figure by the cost of equity, which is 12%, minus the growth, which is 0.03. Okay. So this will be the present value of dividends to be received after year 3. But the problem is that these dividends will start from year 4, because up to the third year, these were the dividends that we were expecting to pay from the company's perspective. So these were the dividends for year 2 and 3. Now these dividends for which we have calculated the present value will start giving to our investors th after 3 years. That is, this will start from the end of year 4. So if I keep it as it is, it means I'm assuming that these dividends will be paid right from the very first year, because the dividend growth model assumes that the first dividend will be paid after 1 year. But these dividends are actually paid, these dividends will be paid after 4 years. So the normal dividends are expected to be paid from year 1 onwards, whereas in this case, these dividends will be paid from year 4 and onwards. So there is a 3 years delay between these dividends. So we have to multiply it with the discount factor as we used to do it in case of delayed perpetuity examples in the day 1. So we have to multiply it with the discount factor to get the present value. So from here till here, it was just simply the dividend growth model. But now, because these dividends will be paid from year 4 onwards, so we have to multiply it with the discount factor to incorporate the impact of delay in dividends. So may I know the discount factor at 12% for year 3? Discount factor for year 3 at 12%. Should I apply the formula, or are you people are telling me the discount factor? Okay, let me apply the formula. I don't know. 1.12 raised to the power minus 3. Here we go, we've got the present value. Is it clear? Or should I repeat? Is everybody alive? Hello? Did you people get it, or should I repeat? Okay, let me repeat. It's very simple. We need to find out the present values of all the dividends that we will be receiving in the future. And the sum of the present value will be actually the value of the company. The problem with this question is that there will be no dividends in year 1. So there will be no dividends, no earnings. So no need to calculate the present value. In year 2, the dividends will be 500. So we calculated the present value of 500 at 12%. Then we have dividends of $1,000 in year 3. So we calculated the present value of the third year's dividend. From year 4 onwards, the dividends will grow at 3% per annum, and it will be paid in perpetuity. So we have to use the dividend growth model first. But remember, the dividend growth model assumes that the first dividend will be paid in 1 year's time, whereas here the first dividend will be paid in 4 years' time. That means there will be a 3 years delay. So once we have used the dividend growth model, in the end, we'll have to multiply it with the discount factor of 3 years to incorporate the impact of delay in those dividends. So first, we just simply need to use the dividend growth model, in which we have to place the dividends 1000, which will grow at 3%, so that it will give us a dividend at the end of the 4th year. Then we'll divide it with KE minus growth. So up till here, it's just simply the dividend growth model. So since the dividends will be paid from the end of year 4th, therefore from the end of the year 4, therefore we have to multiply it with the third year's discount factor, and I've just put in the formula. So by multiplying it with the discount factor, we have actually incorporated the impact of delay in these dividends. So it's 8145.93. Now if I sum all these values, I will get the total value of the company based on the future dividends to be received. So this is the total value of the company based on future dividends. Any questions? The next part is calculate the current weighted average cost of capital of Corehab company and the weighted average after-tax cost of capital following the new debt issue, and comment on the difference between the two values. So what we need to do is to find out the weighted average cost of capital of the company, that the current weighted average cost of capital of the company, and then the revised weighted average cost of the capital. So the current weighted average cost of capital, for that we need to calculate the cost of equity, which we have already calculated. And in the question, we have been given the cost of debt as well. So we don't need to calculate the cost of debt. All we need to do is to find out the weighted average cost of capital. So current WACC will be equal to 12% into the weightage of equity. Equity is 75% at the moment. So we'll take 75% of the cost of equity plus 25% of the cost of debt, because debts are 25%. So 25% of the cost of debt. So if we multiply cost of equity with the weightage of equity plus cost of debt with the weightage of debt, we'll get the current weighted average cost of capital of the company. Here we go. So this is the current WACC. Now, what is happening? So we just need to read this para to find out what changes are occurring in this company's capital structure. During the course of the last 2 years, the company acted to reduce its gearing and was able to redeem a large amount of debt. Since there are now clear signs of economic recovery, Kodak company plans to raise further debt in order to modernize some of the non-current assets and to support the expected growth in earnings. This additional debt would mean that the capital structure of the company would change, and it would be financed 60% by equity and 40% by debt. The before tax cost of debt of Kodak company would increase to 6%. Now earlier it was 5%, now it will be 6%. And the equity beta, which was 1.6% here, will increase to 2% here. So definitely with the increase in this cost of with the increase in this equity beta, there will be an increase in the cost of equity as well. So first let us calculate the revised cost of equity using the same CAPM formula as we used for the previous part. So the risk-free rate of return, it stays to be 0.04. plus equity beta is now 2 times into the risk premium, which is 5%. So the revised cost of equity with this change in the equity beta will be 14%. The revised cost of debt, according to the question, is 6%. So the revised weighted average cost of capital will now be 14 into the new weightage of equity, which is 60%, plus the revised cost of debt with the revised ratio or weightage of debt, which is 40%. So the revised cost of capital will be 10.8%. Is it clear? Okay, let's move towards the next question. Calculate the value of Denoka company using the following methods: price earning ratio method and dividend growth method. Just go ahead and solve both parts and we'll discuss in a while. Two minutes for each part. What's the value of the company using PE ratio? May I know the total value of the company? What's the total value of the company? Total value will be equal to earnings into PE ratio. So the earning per share is 40 cents, 40 cents, which means $0.4 into the price earning ratio of the industry, which is 10. It will give us the per share value multiplied with the total number of shares, which is 5 million. So I will multiply it with 5,000 to get the value in thousands. So the total value of the company is 20,000, or we can say 20 million. Is it clear? It's very simple. We picked the earning per share in dollars, multiplied with the earning PE ratio to get the value per share, and then multiplied with the total number of shares to get the total value of the company. Then we have to calculate the same value using the dividend growth model. And for dividend growth model, we need cost of equity. So first, let's calculate the cost of equity. And the cost of equity should be calculated using CAPM model. The risk-free rate of return is 4.6%, 0.046, plus the equity beta is 1.4. It's 1.4 into market return, which is 10.6, 0.106, 106 minus risk-free return, which is 0.046. So the cost of equity is 13%. 13%. Now let's calculate the price or total value of the company. Dividend. For that, we need dividend per share. The earning per share is 40 cents, and the payout ratio is 60%. So it means that the dividends paid are 60% of the earning. So okay, let's keep it in cents. 40 cents into 60%. So the dividend per share would be 24 cents. Okay. Let's calculate growth as well. it says that the dividend per share 1 year ago was 23.3 cents, and it was 22.0 cents 3 years ago, 2 years ago. Whereas the current dividend is expected to be 24 cents. So the earliest dividend, so the latest dividend is 24 cents. The earliest dividend is 22 cents. The number of years in between 2, so 1 upon 2 minus 1. And if you change it to percentage, it gives us 4.45% growth. So 24, the latest dividend, which is just expected to be paid. 2 years back, the dividend was paid as 22 cents. So it has grown at a particular rate. So we need to find out that rate, which is 4.45% per annum. So we've got the growth, we've got the dividend per share. Now let's calculate price per share, and then we'll calculate the total value of the company. Price per share, we need dividend per share into growth, 1 plus, to close it, and then divide it by KE minus growth. Okay, it was in cents, so it was in cents, so we have to, the value will be in cents. This answer will be in cents, and we have to convert it into dollars, so we'll divide it by 100. $2.93. So can you show the growth cell again? Yeah, sure. The latest dividend, the earliest dividend, the number of years in between, and then minus 1. Okay, Abdullah, just look at the growth formula. It's the same as we did last time. The latest dividend is 24 cents. Here we go. The earliest dividend was 22 cents 2 years back. So the latest dividend divided by the earliest dividend raised to the power the 1 upon number of years, 2 years. So in this way, we have got the growth, and dividend per share is very simple. The earning per share was 40 cents, and 60% of this was paid as dividend. The dividend proposed payout ratio is actually the payout ratio of the dividend. So 60% of the earnings is expected to be paid as dividends. So 40 into 60%. So the price per share, and now calculate the total value. Total value will be price into number of shares. 5 million. Here we go. So here is the total value of the company, 14 million. So this was the total value using the PE ratio, and this is the total value using dividend growth model. Is necessary to calculate figures in cents? No, it's not necessary. You can have it in cents or you can have it in dollars. It's up to you. But the total value should be in dollars, but the per share values may be in cents or it may be in dollars. Okay, is it clear? Should we go forward? Price per share. Okay, it's simply the at the end I have divided it by 100 because all the figures were in cents, so to convert it into dollars I have divided it by 100. GS, is it okay now? Okay, so let's move towards our next question. Okay, well, calculate the following current values for each $100 convertible bond: the market value of the convertible bond, the floor value of the convertible bond, and the conversion premium. So let's first calculate the market value. As I told you that the market value of or the price of any debenture or share depends on its future gains. If I am going to buy the share of a company, I will look at what benefits I'm going to get from those shares in the future. And I will calculate the present value of those future benefits either in the form of dividends or earnings or the cash flows. And that present value will be the maximum that I'll be willing to pay for that share. Similar, Similarly, when I'm supposed to calculate the market value of any debt, I'll look at what I'm going to receive from that in the future. As you know that if you buy bonds or loan notes of a company, uh, you will be getting interest payments every year for a certain period of time, and at the end of the term you will be getting your investment back either in the form of cash, or you may get an option of buying shares of the company, which and in that case it will be called convertible debts. So all we have to do is to find out the present value of those interest payments and whatever we are going to get after the end of the term. So we have to calculate the present values of those. So let's calculate it. Let us first read the question. Forbes company has in issue 9% bonds, which means that we'll be receiving 9% of the par value as interest every year. These are redeemable at their par value of $100, okay, in 5 years time, or each bond may be converted on that date, that means at the end of the 5th year, into 20 ordinary shares of the company. The current ordinary share price of Forbes company is $4.45 and is expected to grow at a 6.5% per year for the foreseeable future. Forbes company has a cost of debt of 7% per year. Okay. We'll be receiving interest payments, and we'll be receiving either $100 against one bond, or we may get the number of shares. So whenever you have convertible bonds, the first thing that we have to do will be to find out what is the likely decision to be, and that decision will be from the investor's point of view, because this will be at the discretion of the investor and not the company. So from the investor's point of view, we have to find out that what is the likely decision, what will be the likely decision after 5 years. So definitely after 5 years, the investor will be comparing the redemption value with the conversion value of the bond. So let's first calculate the conversion value expected to be in 5 years time. Conversion value. Now, as you know, against each bond, the investor will be getting 20 ordinary shares in this case. Each share has a current market price of 4.45, but definitely the conversion option will be available after 5 years. So we need to find out the price after 5 years. So according to the question, the share price will be growing at the rate of 6.5%. So 1.065 into, sorry, raised to the power 5. So what the price is likely to be after 5 years, this is how we will calculate it. So the total value of these 20 shares after 5 years will be 121.94 dollars, which means that against every bond, which will be against every $100 par value bond, the investor will have the option of getting shares with a value of $121.94 in 5 years time. On the other hand, the investor will have the option of getting a cash value of $100 par. So what do you people think will be the choice of investor, conversion or redemption? So the investor is going to convert it. So this is what he'll be getting after 5 years. So what we need to calculate the present value of this debt or the market value of this debt. For 6 years, for 5 years, sorry, it will be getting this 9% interest and 9% of the par value. 9% of the par value. Since par value is $100, 9% of the par value will be $9. So for 5 years, this investor is going to receive $9 every year. So in order to calculate the present value of these $9 that the investor is going to receive for 5 years, we need to multiply it with the 5-year annuity factor. So for annuity factor, remember, we have to use the cost of debt, 7%. So can I have annuity factor for 5 years at 7%? 4.1. Okay. So if I multiplied 9 by 4.1, I'll get the present value of the interest payments. But this is not the only thing that the investor is going to get. After the end of the 5th year, he is also going to get $121.94. But since this will be a single amount, so we have to multiply it with the discount factor at the same rate at the end of the 5th year. So may I know the discount factor for the 5th year at 7%? I think it's better. I need, okay, for 0.713. So if I solve it, I get 123.84 dollars. This will be the market value of this $100 par value bond today. So the market value of any debt will be simply the present value of the interest payments that investor is going to get and the present value of whatever he's going to get after the end of the 5th year. If it's a straight debt with no convertible option, it will be the present value of the redemption value. But if it's a convertible debt, then it will be the higher of the redemption value and conversion value, which he will be receiving after the end of the 5th year. Is this clear? Okay, let's move forward then. So this is the market value of this convertible debenture. Now, it says calculate the floor value. Floor value is the minimum value of any debt. Now, I want you people to listen very carefully because this is a slightly tricky thing that I'm going to explain. Well, as far as this convertible debenture is concerned, it will be traded in the market. It is expected to be traded in the market at $123.84. Now, since this bond contains an option of conversion, and that's why we are taking this B2 value, which is 121.94 as our 5th-year value, and we are including this amount into our present value calculation. What if what if there was no option of conversion? In case there was no option of conversion, we would have been using this $100 figure rather than 1 to 1.94, because this is the redemption value. So we would have been using this $100, and in case we had used this $100, the value would have been lower than what we are getting now. So in the worst case, in case the conversion value, because at the moment we expect this share price to grow at the rate of 1.065, we expect it to grow at 6.5% per annum. What if it does not grow at all? Then the conversion value after 5 years will be 20 into 4.45, and this may happen. So in that case, the conversion value will be just 89, and no investor would like to convert this bond into ordinary shares. In that worst case, every investor will go for redemption. So no investor is going to get less than $100 after the end of the 5th year. So floor value is actually the value which will be minimum value of the bond in the worst case. So the worst case for any investor will be, let me copy paste this figure here. The worst case will be that the investor will be getting $9 every year for 4 years, but at the end of the 5th year, in case these shares do not grow at 6.5% and stay as they are, the investor will go for redemption and they will get $100. So we'll just write B3 instead of B2 here and multiply it with 0.713. It means that this is the worst possible value of this debenture, and that's why it is called floor value, the minimum value of this debenture. So even if the conversion option is not likely to be chosen by the investor will still have the value of $108.2. This is called floor value. Is it clear? Is that clear? I think you all are waiting for someone else to answer this question. Is that clear? Okay, so in case where you are asked to calculate the floor value, we'll use the same formula as we did in case of market value, but instead of writing the higher of these two, we'll just write the redemption value as the 5th year value. In that case, we'll get the floor value. But in case we are asked to calculate the market value, we will always use the higher of these two values. Now it's time to calculate the conversion premium. Conversion premium is actually the difference between the current conversion value and the market value. This is the current conversion value, that is without any growth. If in case, though it's not the case, but if in case the conversion takes place today, each share will have a price of 4.45 and multiplied with 20 will give us a value of $89. $89. So this is the current conversion value. So if we take the difference of the market value and the conversion value, we will get the conversion premium, which is $34.84. So conversion premium is actually the difference between the market value and the current conversion value. Should we move forward? I am not um, uh, getting active participation from you people today. Seems like you people are tired today. Okay, let's just tell me how many of you are working students? Okay, we've got one student. Who else is a working student? Great. Okay. That's it? Only 4 students here who are working? Well, I will conduct 1 or 2 separate sessions because as you know that this is the last day for the practice to pass sessions, but I will conduct at least 1 or 2 more sessions for you people, but it will be only for those students who are actively participating today. So I'll be judging you people today for the rest of that 1.5 hour that we are left with to and I'll judge how many of you are actively participating, and I will conduct sessions for you. And uh, though I won't give you a guarantee, but to the best of my experience, I can assure you that after those 2 sessions, you will be more confident for appearing in your exams. Well, Shoaib, the only way to remove a fear is to practice a lot. So if you practice more and more, the fear will just go away. It's just the lack of practice that we are always afraid of doing something or trying something that we've never tried before. So if you practice more and more, you'll get familiar with the spreadsheet, with the Excel. And once you get familiar with Excel, you will be more confident. Okay, should I move forward? Okay, let's take a 10 minutes break because I have to offer my prayers and you people deserve a break as well. You've been very patient today. Okay, Sneddon, don't be afraid of. I'm telling you that I'll be conducting those sessions, and it will these sessions will be very confidence boosters for all of you. So don't get tensed. It will be okay. So let us take a 10 minutes break, and we'll be back in 10 minutes. And once we are back from the break, we'll just discuss the question right on your screens, and for the rest of the session, I'll just be discussing your queries. So meanwhile, in these 10 minutes, just gather the queries that you people have regarding your so far studies, come up with the questions, come up with the topics that are bothering you, and we'll discuss that for the rest of the session. And then on the WhatsApp group, I will update you on when I'm going to have those additional sessions, one or two or sessions, and what topics I will cover on those sessions. I'll update you on the WhatsApp group. So in these 10 minutes, just come up with your queries or with other problems that you're facing. Shoaib, on the chat box, the WhatsApp group and my contact number will be shared with you. In case you are not able to join that WhatsApp group, just text me on the WhatsApp. Yeah, Sneddon, in one of those sessions that I was talking about, we will be discussing market hedging as well. Not market hedging, we'll be discussing hedging techniques for exchange rate. Okay, let's take the break and be back. Hello again. So I hope I'm audible to everyone. Are you people there? Okay. Distinguish between weak form, semi-strong form, and strong form stock market. Well, all these things relate to efficient market hypothesis. Well, what is efficient market hypothesis and what it has to do with our business valuation topic? What is its significance and what are weak, semi-strong, and strong form efficiencies? Well, I'll just explain efficient market hypothesis with a very simple example. Let us suppose that one of you is going to buy a car from one of his friends. Your friend has told you about the car, the features the car has, and the model of the car, the condition of the car, everything. And after once he has told you everything about the car, you have made up your mind to buy that car for, say, for example, you've made up your mind to buy that car for, say, $10,000. So you've made up your mind to buy it for $10,000. And when you are when you're leaving your house, you are told by another friend of yours that that car has got a minor accident and there's a big scratch on the car now. So now you've come to know about that incident. So will you still be buying this car for $10,000? Will you? Of course not. You won't buy that car. Now, this information that has come to you has affected the value of that car. And since it was a negative information and an adverse information, so it will have an adverse impact on the value of the car. So similarly, whenever a new information comes into the stock market, it affects the value of the shares. And efficient market hypothesis is all about the efficiency of stock market with which it processes newly available information and reflects it into the share price. This is efficient market hypothesis, which tells us about the level of efficiency that a particular stock market will possess in processing a new information and reflect it into the share price and reflects it into the share price. There are three forms of efficiencies that may be there in a stock market: weak form, semi-strong form, and strong form. The weak form is actually when a stock market only, or the prices prevailing in the stock market only reflect the historic information. which means that the share prices will only change when something actually happens and becomes history. It will only reflect those changes. This is called weak form of efficiency. Theoretically speaking, it may be possible, but practically it's not possible that the people in the stock market, the investors in the stock market, will not be aware of something that is publicly available. So they may not be aware of information which is available to everyone else around the world, but the stock market people will be unaware of something. It does not make sense. So usually the stock markets will possess semi-strong form of efficiency. That is, all the stock markets in the world, they will process historic information along with every publicly available information. And since it's an era of communication technology, the communication is so fast these days that anything happening around the world will become viral in no time, and everybody in the stock market will be aware of that information. So whenever a new information is made public, the stock market prices will respond to that. So in a semi-strong form of efficiency, the stock market will reflect historic information along with any publicly available information. So no one with publicly available information will be able to gain from that information. You can't say, I have come to know something that everybody knows it, and I'll still buy the share at a lower price. And when the people in the stock market will come to know about that public information, the price will go up. I will sell the share and will gain from it. No. The moment you get that information which is publicly available, everybody else is going to get that, and the stock market prices will just immediately go up. And the moment when you will be buying that share, you'll already get it for a higher price if that information is a positive information. So you won't be able to gain from any publicly available information. Yeah, the only way that you can gain will be your speculation skills. If you are able to speculate about the future gains of a particular company and nobody else is able to speculate that information, you will be able to gain from that information. For example, with your experience, with your ability to do financial analysis, you did an analysis about a company, and the outcome of your analysis was that you started expecting that the company's earning will grow in the future. And based on that speculation, you bought the shares at a lower price. And then after a year or 6 months or 2 years, if 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 the gains that you were expecting are actually earned by the company, the share price will go up and you will be able to gain from that. The third form of efficiency is the strong form efficiency. The strong form efficiency is actually when a stock market not only reflects the historic information and the publicly available information, but it also reflects the information which is confidential, the information which has not been made public by the company. And the stock market reflects that information into the share prices, even if that information is not made public. This is called insider dealing. Definitely somebody from inside the organization may have leaked that information into the market, and the share prices may have changed because of that information. This is an illegal form of efficiency, and in practice, this does not exist. So we have three forms of efficiency. Two of them are theoretically there, and one of them is practically there, and that's the semi-strong form of efficiency. So from the business valuation perspective, in the exam question, you may come up with a question in which a company may be taking over another company, and by the takeover of the other company, the company may be expecting to increase its earnings. and you may be asked to value the company based on the earnings, but at the same time, you may be asked to assume, you may be asked to assume that the stock market is a semi-strong market and those earnings that the company expects are not made public. So what value of the company, what will be the value of the company after acquisition, but before publicly announcing the earnings expected? So as you know, in a semi-strong form, whatever is not made public will not be reflected in the value of the company. So you will just simply ignore those earnings and you will not incorporate in the business valuation. On the other hand, they say in the same question, you may be asked to calculate the value of the company with the assumption that the earnings that the company expects after the takeover of of another company are made public. So in that case, since the information has been made public and the stock market is a semi-stock farm market, you have to incorporate the impact of earning into the value of the company. So this is how you may be examined in the question regarding efficient market hypothesis. Any questions? I didn't get it. What do you want me to do? Do you want me to repeat? Which part do you want me to repeat? Yeah, Snyder, you're right. The semi-strong form efficiency reflects the historical information and the public information, publicly available information. Okay, for example, you may be given a question in which one company takes over the other company, and you may be asked to calculate the combined value of the two companies, and you may be asked to assume that the stock market is a semi-stock market, and the takeover of the other company will increase the earning of the company, say by $50,000. So you may be asked that the takeover will result in an additional earning of $50,000 for the company as a whole. But this is what the company's directors expect, and they have not made this figure public. So they haven't told anybody else outside the organization that the company is going to increase its earning by $50,000. Now, what should be the value of the company? So in that case, the earnings should be ignored. Those additional earnings should be ignored as it's a semi-strong farm market and these earnings have not been made public. So unless and until these earnings are made public, it will have no impact on the value of the company, so the earnings will be ignored. In the other case, they might ask you to calculate the value of the overall value of the company with the assumption that these additional earnings expected are made public, that the company has announced that with the acquisition of this new company, the company will be able to increase its earnings by $50,000. Now, everybody in the stock market will know about this because it has been made public. So everybody will be responding in the stock market, and everybody would like to buy the shares of the company. And since the demand will go up and the price will go up, so the share price will immediately adjust to reflect this information as this has been made public. Is that clear? Okay, this is efficient market hypothesis, and I think I hope that everybody has understood it. So before I move towards any other question, do you people have any other questions that you want to ask me? Okay, on your screens, you have a question there. And in part A, we have to calculate what is the current weighted average cost of capital of the company before the issue of new loan note. And then we have to calculate the impact on the weighted average cost of capital after those bonds are issued. So go ahead and just calculate the weighted average cost of capital in part A. You may not have the credentials shape. Yeah, I'm going to share practice questions and theory handouts on the WhatsApp group tomorrow. Just make a correction. Just make a correction. The company also have 3% preference shares in issues whose book value is, you can write it, $0.5 or 50 cents. So instead of 45, it's just write it 0.5. And the current ex-dividend share price is $1.5. I think you can see the problems in the question. No, it have 7% bond with a book value of 80. Sorry, I think there's some problem with the question. It's something missing from in the question. Its current cost of equity is 6% and it has 7% bonds with value of 80 cents. Yes, Hamad, on the Vimeo, you can, okay, forget about this question at the moment. I think there are some problems with the question. Some data is missing in the question. Hamad, you can find my lectures on Vimeo on the ACCA Pakistan page. You have cost of debt, cost of capital lectures on Vimeo, and you can also find business valuation lectures on Vimeo. In case you people are not able to find those lectures, just drop a message on the WhatsApp group and I will try to share the link of those videos with you. There's something wrong with this question, so just just uh, just go ahead and calculate cost of equity only. Calculate the cost of equity using the dividend growth model and tell me what's the cost of equity. For calculating cost of equity, remember we need price, we need dividend per share, and we need growth. So the price of the share is 5.15. 5.15. The dividend paid is 75 cents, which means 0.75. And the growth is something that we need to find out. So using the compound growth rate formula, we just need to pick the latest dividend, which is 75 cents. 75 cents divided by the latest dividend, which is 45 cents. And the number of years in between, ignoring 2001, 1, 2, 3, and 2005, 4. So there are 4 years, and minus 1, and just change the format. It's 13.62%, quite a huge growth. Now cost of equity, dividend 0.75 into 1 plus growth, whole divided by the price, and then at the end we have to add the growth. It's 30.17%. Is that clear? So, hello, can you people hear me? Okay, so let's move and find out the cost of debt. Dino Company also has 6.5% convertible bonds of 34 million in issue, having a conversion ratio of 21 ordinary shares per bond. The conversion date and redemption date are both on the same date in 7 years time. The current share price will increase by 2.5% per year for foreseeable future. The company's current financial position show that 9% 50 million redeemable note in issue, which has a market value of and controlled by the market value of 121. The company pays corporation tax at 20%. So in case of, as you know, in case of the convertible debts, first we need to find out what is the likely decision to be from the investor's point of view. So may I know what's the conversion value in 7 years time? Conversion value. What is the expected conversion value in 7 years time? What's the current price per share? What's the current price per share? The current price per share is 5.15, and if we multiply it with total shares available for conversion 21, and if we incorporate the growth rate, which is 1.025 raised to the power 7, 128.56 approximately, whereas the redemption value will be okay. Nothing has been mentioned about the redemption value. So in case the question is silent about redemption value, it should always be the par value. Remember, in case we don't have redemption value given in the question, it should always be the par value. So the likely decision of the investor will be that the conversion rather than the redemption. So now let's calculate the cost of debt. For cost of debt, you know that we need to calculate IRR in the same way as we used to calculate IRR in the investment appraisal question. For that, we need to use the columnar approach here, cash flows. Okay, from year 1 to 7, it will be the amount of interest, which is 6.5% per $100, which will be $6.5. But since there will be tax impact on amount of interest and 20%, so we'll have to take 80% of 6.5 as interest is a tax allowable expenditure. So 5.2 is the net of tax interest amount that will be received by the investor from year 1 to year 7. Then at the end of year 7, it is going to get 128.56. So we have to assume a discount rate at which we can get positive NPV, and then discount rate at which we will get negative NPV. So let's take 3% as our first discount rate, and let's hope that we get a positive NPV. So can I have NVT factor at 3% for 7 years? And as far as discount factor is concerned, I will calculate it myself. $6.230. 6.230. Okay, so let's calculate present values. Now, the market value per bond. Convertible bond has a market value of $121. So positive PV of 15.92. So this is PV at 3%. And now we'll again calculate present value at a higher rate than this so that we can get a negative NPV. Let's take 10%. So can I have NVT factor for 10%? And I'll calculate discount factor using the formula. 4.868, 4.868, and let's calculate the present values. So we've got negative NPV as well. Let's calculate IRR, which is cost of debt. The lower rate, which is 3%, 0.03. The positive NPV, which is 15.92, divided by the positive NPV minus the negative NPV into the difference between the two rates, which is 0.07. The cost of debt of redeemable convertible is 5.44. Why 3% discount factor? It's just assumed rate. For calculating IRR, we take two different rates and we make sure that we get one positive NPV and when we get the negative NPV. So just to be sure that we get a positive NPV, we have taken 3%. So the cost of debt is 5.4%, but this cost of debt is for the convertible debts. So we've got cost of equity, we've got the cost of debt of convertible. Now do we have any other debt in our capital structure? Yes, we have. We have 9%, 50 million irredeemable loan notes in issue, which is a market value of 94. So these are irredeemable. So for irredeemable, it's very simple to calculate the cost of debt. Irredeemable. All we have to do is to just calculate the interest per bond, which is 9%, and we have to make it after tax. So 9% means $9. So 9 into 80%, that is after tax. And then we have to divide this figure by the market price per loan note. The market price per loan note is 94 bonds, $94. So let's take 7.66%. Is it clear? So we've got all three types of sources of capital, and now we need to calculate weighted average cost of capital. So for the weighted average cost of capital, you know that we need weightage for all these types of sources. Dino has an issue 6 million shares with currently traded at 5.55. So let's first calculate market values. Firstly, calculate the market value of equity, which is 5.15 into 6 million. We'll write it in thousands. So market value in thousands. Equity, and then we have convertible bonds, and how many, what's the market value of the bonds? has 6.5% convertible bonds of 34 million issue. So we have 34,000 par value bonds, 34,000, and each bond will have a market par value of 100. So we'll divide it by 100 to get the number of bonds and multiply it with the market value per bond, which was 121. So 121. So this will be the market value of the bonds. It's too high, I'm afraid. So after bonds, we have loan notes. Loan notes. The company contains 50 million loan notes, and again, loan note will have a market par value of 100. So 50,000 divided by 100 multiplied by the market value, which is 94. So if we sum all these three, we'll get the total value of capital. Now we'll just write the costs here. Firstly, we have cost of equity. Then we have 5.44. Then we have 7.66. Let's change the format. And then let's multiply. So the total that the company will be paying to all of its investors will be sum of this. This is what the company will be paying to all of its investors. And if we need to calculate WACC, we simply have to divide what the company is going to pay in total against this value of investment. So this is what the company will be paying in total to its different fund providers, and this will be paid against this value of 119040. So we'll divide what the company is going to pay by what the company has acquired as a source of capital. So, and we'll just convert it into percentage. So it's 12.74. 12.74 is the weighted average cost of capital. Why did we divide the loan notes by 100? Snedden, we have divided the loan notes by 100 to get the total number of loan notes. And then we will multiply it with the market price per loan note to get the total value of loan notes. To calculate the conversion value, we have to multiply the current price per share with the total number of shares, and then we'll have to multiply it with the growth rate that we expect, 7 times, because the price needs to be calculated after 7 years because the conversion option is available after 7 years. So the weighted average cost of capital is 12.74 for this question. Now, any questions? Any questions? On your screens, you have a question. Just calculate the risk adjusted cost of equity. And in yesterday's session, we just um, discussed a formula for calculating equity beta and asset beta, if you remember. So use that formula and calculate the cost of equity. So you have 2 minutes to solve this question. Okay, first of all, we have to calculate the relevant cost of equity that will be used by the company. So the given cost of equity is 1.7, but this proxy company has the same business risk, but it may have a different financial risk. So we have to ungear it first to calculate the asset beta, and asset beta will be calculated as the equity beta 1.7 into debt equity divided by debt plus equity. So equity is 60 and debt plus equity after adjusting the tax will be 60 plus 40 into, since the tax rate is 30%, so we have to take 70% of this 40. So 60 with equity and debts after tax and equity in the numerator. So we've got the ratio of equity to equity plus debt. So 1.16 times approximately is the asset beta. Now, we've got the asset beta, which shows the business risk of the company. Now we have to use the debt to equity ratio of advert company to incorporate the financial risk of advert company. Is it okay, Yasmin? Okay, for that we need to calculate the equity ratio of advert company and the debt ratio of the advert company. So uh, it has 4 million shares, which with a value of 6.5. So equity, 4 million shares, 4,000 into 6.5. So the total value of equity in thousands, and the total value of debts in thousands will be 18 million nominal value. It means 18,000 divided by par value to find out the total number of bonds multiplied with the market value per bond. So if we sum, we get the total value. Now, if we calculate the weightage, it's 26,000 divided by 21060 divided by total value. So here we go, we've got the weightages here. So we can take it as 55% and 45%. So let's calculate equity beta again. But this time we have to use the weightages of advert company to incorporate the financial risk of the company. So we'll take the asset beta and we will multiply it with the total of these two, because we have to do the reverse calculation. So the total of the two will be 55 point, sorry, this plus this into 70%. So we'll have to multiply it with this figure and divide it with the equity figure, which is 55 point. So it's 1.82. So the equity beta with the help of asset beta will be as follows. So just look at the formula before we move forward. We have picked up the asset beta, which is in the B2 cell, 1.16. Since we are calculating equity beta from asset beta, so we'll have to multiply it with the total of equity plus debt. Here we go. And divide it by the value of equity, which is 55.24. So the equity beta will be 1.82. Now we need to calculate cost of equity using the CAPM model, in which we'll have to pick up the risk-free rate of return. The risk-free rate of return of the stock market is 6%, 0.06, plus the equity beta, the adjusted equity beta, into market return, which is 13%, minus the risk-free rate of return, which is 6%. So it's 18.71%. So we're done with the part A, which was to calculate the cost of equity, the risk-adjusted cost of equity. Any questions? Then the next part is, what is the current weighted average cost of capital of Edward Company? And now in this case, we need to find out the current cost of equity and the current cost of debt before we can calculate the weighted average cost of capital. So the current cost of equity will be calculated using the current equity beta. So the risk-free rate of return is 0.06 plus equity beta. The current equity beta is 1.3. 1.3. So we'll just take 1.3 into 0.13, the market return, minus the risk-free rate of return. So this is the current cost of equity, 15.1%. Cost of debt, we have only one source of debt, which is the 8% bonds with nominal value of 18 million, and nowhere it is mentioned that it will be redeemed, so we'll assume it as irredeemable. So for irredeemable debts, we just need to take the after-tax amount of interest divided by the market value per bond. So it's 8% before tax, and after tax it will be 8 into 70%, and then we'll divide this by the market price per bond, which is $117. So it's 4.79%. Now, since we have the equity, the weightages here, we've already calculated the weightages. So we'll just write these weightages again. Oh, we don't need to write it. We'll just calculate WACC in a separate cell. 15.1 into the percentage of equity plus 4.79 into the So here, 10.48%. That's it. This is weighted average cost of capital. I hope it's clear. So we are done for today, and I will update you all on the WhatsApp group about that additional session that I was talking about. For now, if people have any other question that you want to ask, you may ask before we can wind up this session. Okay, Hamad, I will try my level best to conduct a session, one for Forex, and maybe if possible, we can have another session for any other topic that. Uh, Kumesh, just note down my WhatsApp number. Just send me a text on WhatsApp. Here we go. You have that link to the WhatsApp group, and on the screens you have my contact number for WhatsApp. Just text me on the WhatsApp and I'll send you the link for the group. Sneden, traditional market, what do you mean by traditional market? Are you talking about the traditional theories and the capital structure theories? Well, I'm not sure. I will just update you all about that session on the WhatsApp group, that what we are going to cover in that group. Tufail, we will have a discussion on how to overcome the problems with writing uh, explanation type questions. We will discuss it in that session, because this is something that majority of you have been asking about. So we'll discuss about how to overcome these problems. So don't worry, everyone. Even if you have fears about F9, uh, it's 8th of August now. It's almost 1 month before your exams. And from now till your exams, I will always be available on the WhatsApp group. And I will try my level best to provide you full support, so that maximum of you, or I will pray that um, all of you should pass your exams. Well, I know I only had 10 hours for these 4 sessions, and I tried my level best to not only make you people practice on questions, but to give you a brief concepts of every topic. I know that the time wasn't enough, but still I tried my level best to convey concepts as much as I can, as I could. So I hope these sessions were helpful, and we will stay in touch on the WhatsApp group as well. Okay, guys, it's bye-bye from my side, and best of luck for all. Okay, thank you. Have a good day.